It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey, it's Tyrone Jackson, the wealthy investor, and welcome back to another dazzling episode of Trading Stocks Made Easy. You know, I wanted to talk a little bit today about risk, right? I wanted to open up today's show talking a little bit about risk because all risk is not the same. A lot of people say, I would never put my money in the stock market because it's too risky. Well, that's true, and it's also not true. There are certain stocks, members of the Dow Jones Industrial Average, and those are companies like AT&T and Verizon and IBM, Coca-Cola, McDonald's. These are companies that inherently have in the ownership of stock less risk. And why is that? Because these companies all pay a dividend and they all have established records of earning billions and billions of dollars around the world. So if you wanted to put your money into a Dow component, that means it's going to be less risk. Now, if you're attracted to a stock like, let's say, for example, Tesla, which is not a member of the Dow Jones Industrial Average, but you think the stock has a huge potential to run up, you are taking the largest amount of risk with your portfolio as possible because that company does not have an established track record of earnings and it does not pay a dividend. Are you starting to get the picture? So really what we do in a Wealthy Investor program is we try to always balance risk a little bit more towards being conservative, having most of our money in Dow components, and then we can choose the level of risks that we are comfortable with, both not only with stocks, but also with options. We've been talking a lot about options on the show. Well, when we come back from this commercial break, we have a very special guest with us who, unlike me, was actually a Wall Street insider, meaning that he was on the floor of a particular exchange, and he has a specific perspective on both options trading and mutual funds as well as stocks. And we're going to meet our special guest right after this break.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income-generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
Wealthy Investor, Wealthy Investor, wealthyinvestorradio.com.
And welcome back. Okay, right before the commercial break, I was telling you about our special guest, and his name is Josh Bellinger. And I really like what he has to say, and I think you should listen to him today, too, for his perspective on mutual funds, and then also on options trading. Josh, welcome to Trading Stocks Made Easy. How are you?
I am doing well, and thank you for having me.
No, it's a pleasure to have you here. I love the fact that you were, I call you a Wall Street insider because you were actually on the floor of a trading exchange. Can you just tell the audience, because you did some pretty terrific things early on, how you got experience and got exposed to the game of Wall Street, got your Series 7s, and started out working for a firm?
Yeah, it sounds sexy, right?
Yes, it does. It actually does.
Wall Street insider coming on here. Well, as much as it does sound sexy, and I do have that experience, what we'll talk about is kind of unraveling or opening that curtain a little bit and kind of helping your audience, just like I tell my audience, that the playing field's pretty level at this point. So how I started on the floor was when I was 19 years old. I cold called every firm in the Chicago Mercantile Exchange. I did it the hard way. I wasn't interested in going to school. I was delivering pizzas, and I got the idea from my boss at the time, who said if I wasn't doing this, it'd be cool to be a stockbroker. And then right then and there, it just clicked for me. So that was kind of my mission and what I wanted to do. A couple doors down from the pizza place was an Edward Jones guy named Russ. He'd order pizza sometimes. I went in there, 19-year-old Josh going in there one day asking him, hey, I want to be a stockbroker. And Russ kind of looks at me. He's like, okay, well, do you have a Series 7? Do you have a book of business? And these are all things that the financial industry looks at. Book of business being clients, Series 7 having a license with a firm. He knew I didn't have that. So he said to me, well, these are the things that you need to get to. I think the best opportunity, I used to work on the floor. That would be probably your best way to get in to the business, your foot in the door. And then probably from there, if you still want to go the stock, become a stockbroker, or now what we call them financial advisors, you could go that route or maybe whatever way it takes you. I said, fair enough. He says, but I don't know anybody. So that's all I have for you.
Okay.
That was enough for me. I went on the CME website, Chicago Mercantile Exchange, and I just dialed. And I finally got an opportunity to interview. They didn't take me on the first interview. They called me back a few months later after they hired somebody else, and they needed somebody for a position to be a runner, which is the lowest man on the totem pole. And that was how I got my foot in the door.
And did you get paid as a runner?
Yeah, I made minimum wage. I still worked at the pizza place at that time.
And from there, and from that experience, so you really didn't make how much? Because a lot of people always want, we see these movies and the Wall Street traders are making millions and millions of dollars. Someone who's entry level, like the position that you just cited, how much would they be looking at a week?
At that time, I think I was making, it was whatever minimum wage in Illinois at that time, and this was over a decade ago. So it was right around those areas. I didn't really look at it as that, and I looked at it as, instead of going to college where they didn't teach you anything about investing, and I wasn't going to get, I value, and still to this day, and how I approach things is I always value experience over information. And when you can combine the two, then things make sense. So to me, it never made sense to go 4 years and then get into the real world, and then for a company to retrain you again. So the owner of the pizza place I worked at for many years, Jimmy, who owned the place, he went to school, got a nice 4-year degree, paid a lot of money for it, and then went into GE. And he would tell me stories all the time. He'd say, GE just kind of looked at the certificate to say, hey, thumbs up, but now we're going to teach you exactly how we do things. Right. So it didn't really make sense to me. And that's kind of the way and the reason why I went that way. And I also knew that I didn't have an edge in the kind of school that I would go to or would go to compared to some other individuals going to, top schools and competing with them. So I looked at it as getting my foot in the door with experience and working my way up compared to then, coming to them 4 years later and saying, hey, I have a degree. Can you hire me?
I think we totally get the reasoning behind that. But the Series 7 on Wall Street or working for a firm, big deal. Tell us what the Series 7 is and if you feel like that gave you any advantage as a trader and an investor.
Yeah, so after a while of paying my dues, I kind of saw how technology was changing and the opportunities were less. And I wanted to become a broker. So the next step to becoming a broker is a firm has to hire you and they have to sponsor you to get a Series 7. Series 7 is just kind of a fiduciary license that says you're going to do right by the client. And in that test, I think it's a 7-hour test. It's 225 questions, 250. It's been so long. But the book that you have to study for is 1,000 pages, and it's a pretty big book, but it's really all about like doing the right thing. It's all about the rules and so forth. So my thought was, after I passed that, the gold is on the other side of the rainbow, and it really wasn't like that.
What happened once you got the Series 7?
The one firm that was going to sponsor me was going to still pay me the same amount. So I worked there for a little bit, and I had to say, I can't keep doing this. I got to find a better opportunity. So I eventually went to another firm that sponsored me. They're going to start me out a better salary, but I didn't really like the movies, like the Boiler Room and things of that sort. Times have changed from when I had done that. So I was making working in a boiler room environment, making 600 calls a day, but it wasn't as glamorous as the Hollywood movie made it to be.
Right. And so the Series 7 is also regulatory in nature, basically meaning that you understand the rules of what you can and what you can't say, how exchanges work, things of that nature, right?
Yeah, not so much how exchanges work. It's more about your responsibility for your customer. So it's more like that. So you do cover some different things like how bonds work and how options work, which kind of what led me into really focusing on options. But really the majority of that test is really about it'll ask you multiple times of like in different ways, like doing the right thing for your customer and making sure you really have their fiduciary responsibility. It doesn't really teach you anything about how to become a better investor or how to trade for your client.
Right. Now, once you have a Series 7, does that license need to be renewed?
Let's say if you stay at the firm, you have to do like a maintenance program. So I think every few years you have to kind of go in, but once you pass it, you don't ever fail it. But if you are out of the industry, like I've been, and you're more than 2 years, that license does expire. And if you actually go back into the industry, then you have to retake that test again.
Okay. Well, you have a pretty hot business going on your own, so I have a hunch you're not going back to work for a firm anytime soon. Is that correct?
Yeah, I have no interest in going back to the financial industry. I stepped away. I walked away from it for various reasons. There's a lot of legalities issues with how, if you want to help, and the same thing that you do, if you want to help the everyday investor, the do-it-yourself investor, you can't do it when you work under a firm because there's so much, there's so many legal issues that come in part of it that make the firm liable, make you liable, and it just becomes a big headache. It's really just not worth it.
It's funny you mention that because I had dinner with someone who is a stockbroker whose clients have millions and millions of dollars. And we were talking at this dinner, obviously, about strategy. And so I started to show him some of my strategies that I designed around Dow stocks and covered calls and the money out of the money, et cetera, and stock splits. And I said, I just always wanted to know, why don't you just do this for your clients? And he said to me, Tyrone, they won't let me. I said, but you'd make hundreds of thousands of dollars for your clients. And he goes, the legal department would be all over me if I did just half of what we talked about at this dinner. So that was very enlightening for me to see the kind of restrictions that are on financial advisors and stockbrokers. Were you amazed at that when you discovered that?
When I started to learn more about that, because when I came, my transition was a little bit different. I worked on the floor, so I got to see how things transacted in an open outcry system, meaning they're yelling at each other, what people would refer to. So when I came and worked into an office, I come from all that excitement, all that buzz coming around me, getting elbowed to get trading tickets from sitting on a desk and then asking my peers, hey, what do you think the market's going to do? Or what should I tell these clients? And I would always be told, it doesn't matter what you think, just go gather assets.
That's correct.
So I like I said a couple minutes ago about how I kind of got into options, I really focused on the options part of the Series 7. And from working in the futures exchange, I kind of really gravitated towards the leverage and also how derivatives work. So I would talk to clients about options, and kind of confusing because a lot of them didn't understand options. It's more of the stock.
Sure. So
that's kind of what really honed me into kind of, well, that's my uniqueness. Let me keep honing in on this. And I was doing it myself. And like I was telling you earlier, how I lost on my first trade, the Wall Street insider aspect sounds really sexy, but even after my Series 7, even being part of the financial industry, it didn't teach me how to become a better investor or trader, because I lost $2,000 on my first trade with a Series 7, working in a firm, all those fun things with it. And that $2,000 was lost within a matter of a day playing call options on the stock at the time was Research in Motion.
Well, oh my goodness. Wow. Okay. I remember that one. Well, it's so interesting because we're going to talk a little bit about options trading and time and derivatives, et cetera, et cetera. But for those of us who wind up being successful outside of Wall Street, we all have to lose money. That's how you learn what to do and what not to do, right? So I say welcome to the club. Well, you've done pretty well for yourself. You don't need my endorsement there. But that's something I just want people to understand, that most of us who wind up being very successful, we have to lose money in that process. Would you agree with that?
Yeah. Here's the thing. Losing money is part of it. When you look at any business, every business loses money. The difference in trading or investing or the stock market is that you can see it real time. And in any kind of business you have, where every month you have bills coming out. So that's a loss of money. And you have different times where you do things in business and it doesn't pay off instantly. Like with a trade, like you want to make money right now. And that's the kind of the good and the bad, or the double-edged sword of the financial markets. In business, you could do something and it could take a week, a month, a year, 2 years to eventually pay off. But you don't see that because you can't put context around it right then and there. Unlike the financial markets, where you always have numbers coming at you and you can see it and you can evaluate it real time, people don't realize that or understand the value of their time as well, where if they're sitting in front of a computer for 3 hours on Facebook, how much of that time do they value, or what is their worth of time? That's a loss of it. So you lose a lot in life.
Yes.
It's money. It's about understanding how, I wouldn't say lose less, but managing what you were talking about at the top, risk.
Yes.
Understanding the risk part of it, where yes, you're going to lose, but that loss is not going to take you down to a point where now you're scrambling and you're looking at it as like, oh, now I got to make all this back up, because you can't look at it. Once that happens, the odds start to skew dramatically against you, because now you're putting yourself in making decisions that probably are not in your best interest.
That is correct. Really, really, really important. Now, I am of the opinion that mutual funds, and this is not about downing anyone, but I think mutual funds kind of lull the average investor to sleep, because you're basically giving your money to somebody else and hoping that they actually know what they're doing, right? Whereas I always say, if you actually start investing in stocks on your own, you're more likely to do the research, be intellectually connected to the stock, et cetera, et cetera. You have some views about mutual funds and that are a little bit stronger than mine. You have 3 ways that mutual funds legally steal your money and how to stop them. So why don't you take us through some of your points of view on mutual funds?
Well, just like you were talking about with your buddy sitting down, how come you don't use options? How come you don't do this? And the easy thing, and there is the issue with the compliance department. Compliance is the legal part of it. Compliance oversees the firm. When you have a bunch of customers or clients, everyone is different. So it's hard to just do one thing for all clients. So it's easier to do nothing or little for most clients than doing a few. There's also the risk part of it, where they have to bring in a new risk team that costs lots of money. And if customers are not demanding this, there's really no need to do that. So that's why in the financial industry, honestly, is still 10 years behind. If you go to any professional firm, their technology is archaic. Some of the systems I had to use were years past. And it's interesting how the financial industry takes so much time. I mean, I bet some of them still use BlackBerry devices and things of that sort, or even pagers like doctors do. But the point that I'm trying to hammer on this is that there's no benefit for your buddy to do anything more than what he needs to do. And it's the same thing with mutual funds. There's no added benefit for a mutual fund to outperform. There's no really added benefit for a registered investment advisor to outperform, because it exposes him into different issues. If they do take on too much risk, they don't know what they're doing. There's all these kind of things that go behind it. So the status quo is just to do less is more. And that's how kind of mutual funds approach it as well. So with the mutual fund, automatically you're 1% to 2% negative.
Yes, because of loads?
Well, you have there's all kinds of different fees. I mean, on average, it varies from 1% to 2%. I mean, it's a little bit less and sometimes a little bit higher, depends on what it is. You have some of these different types of funds now where they're target date retirement funds, and they carry a little bit higher of a load. And those are these, hey, if you're 20, you're 25 now, you're going to retire at 20 whatever. And by that time, we'll put you in this fund. And during the course of this fund, we'll take you out of more. We'll manage it where you have more bonds later in life and you have more equity early and whatever else they sell, which is just a sales pitch. They're not doing anything. So those do carry a little bit higher fees. So they're trying to make these little packaged kind of uniqueness things of like, hey, let us do it. Because that's how all these mutual funds started. Mutual funds started way back, I believe around in the 80s, where if we think about kind of how our society has changed over years, you had unions in the 50s and 60s, and they took care of their employees. at retirement, at the end of it, you're taken care of. Well, it's all now on the everyday employee or the everyday investor, because companies are not valuing their employees the same way. They don't want that risk. So what happened was when that change occurred, banks saw that as an opportunity and said, oh, okay. So they started with these retirement accounts. And the retirement accounts started as for corporations to defer taxes. But then they started to kind of trickle them down to the everyday investor because they're a loss. There's no one helping them. So, hey, this is what we have for you. It sounds like a good idea, right?
Yes.
Well, it hasn't been. And one of the ways that they continue to kind of transition this and really, box the everyday investor, the blue collar investor. I have all kinds of different names, but the investors like you and I, who in reality are the biggest fund or the biggest pool of funds out there. If we actually took back our money, but we decided to give it to other people, if we took that back, we actually we do control more money than these funds. But what they do, the financial industry, is that they box their investment in. So they protect it with, first of all, a retirement account. Then they protect it with mutual funds.
Correct.
So they protect all these things with these fees, where just kind of like these little nickels and dimes, where for them it adds up. This is a couple $1 trillion industry,
oh, for sure.
$4 billion trillion industry.
Right.
So, they do a lot of lobbying. They do a lot of things to protect their investment.
And also, mutual funds are easy sells, right? It's an easy thing to put in a packet, and it's an easy thing to talk about the long term if you just keep contributing. Because if you just keep contributing, right, then it kind of takes the onus off the mutual fund manager because they don't have to perform. You're putting money in the fund and taking fees. So I understand what you're saying when you're saying the emphasis is not on performance, whereas hedge funds, on the other hand, want to perform because they only eat what they kill. Would you agree with that?
That's the sexiness, and that's where hedge funds try to sell their hook, but they underperform as well. 95% of them, 95% of every year, 90 to 95% of them underperform. So their sexiness is they target a higher net worth individual. Mutual funds are more of the small guy, 100,000. The hedge funds are after the $1 million guys and higher value, where they're selling alpha,
right?
But most of the time they can't, and it's the same way they make their money as well. So yeah, they have a little bit of what I refer to as a kicker, and the kicker being is that they can, if they actually do perform or actually do very well, they get 20% of the profits. Well, yeah, that's the added benefit for them. But again, if you have a $1 billion fund, you're sitting pretty good. Again, at the end of the day, you're going to collect your fees because all of them make their money by having your money invested.
Totally.
And the way they do that is they buy.
Totally.
So that's why in the marketplace, there's always a natural drift in the marketplace. It's about 53%, 47%, meaning 53% that there's always this kind of natural drift in the marketplace. So if you flip a coin, it's 50-50. But because of that, how the markets, how money is invested in the marketplace by these funds that do control a larger portion now, there is this natural drift higher.
Well, hold on now, because we can get into so many interesting issues if you love trading like I do. Really interesting, but we don't have time to get in all of them. So you're going to have to come back. I can tell you that right now. But when you say underperform, you mean underperform the S&P 500 or the Dow Jones Industrial Average on an annual basis. Is that what you're referring to?
I know you started out with Dow Jones. I focus in on the S&P, and it's probably because of how the audience is. So the S&P is the broader index. That's what professionals, that's what everyone typically looks at. The Dow is the easiest way to kind of quote the market. The S&P 500 is 500 stocks. So a lot of times these mutual funds are trying to mimic the S&P 500 because it's already diversified. There's 500 stocks. It's already diversified.
Right. And a lot of people say on a sector basis, you're getting a better reflection on the S&P 500 of the market overall. Correct?
Yeah, I look at it as you're spreading your risk. 30 stocks, okay, 500 stocks. You get different broad aspects to it. Keeping it kind of where we're talking about mutual funds. Mutual funds are trying to do what an S&P 500 is. So not only are they doing that, but then they're taking their let's say 2% in fees, 1%. So you're already in the hole. So now you're dictating on them that they have to make not only what their fees are, but even more than that, which
Correct.
None of them do. And the easiest way for kind of the person to kind of get away from that is just to say, hey, Josh, I hear you. I'm tired of looking at my statements, but what can I do? The easiest thing is you take that money out of the mutual fund, at least take back control of it. Stop letting them make money off you, because you could dramatically increase your outcome or your returns down the road with compounding interest down the road by saving just that 1% to 2% fees every year. And you say, okay, I hear you, Josh. I follow Tyrone, but I really don't want to get that active with it. Cool. The best thing to do is then to just use an ETF, which is an exchange traded fund. We're talking about the S&P 500. You just use the ETF, where there is a little bit of fees on that, but not as you're going to save so much money in fees compared to that. And you also have liquidity. Mm-hmm. Liquidity being important, because if you need to get in and get out for whatever reason, in case of emergency, in case of something comes up, maybe you start to learn how to be a little bit more active and how to manage your profits.
Yes, and you're referring to the SPY in terms of the ETF, right?
That would be the SPY, yes.
Yeah. Let me just ask you this also. In terms of mutual funds, though, because of these fees, this is why you're saying the mutual fund business is one of the biggest scams against the American investor, because of the load and the secondary fees that go along with just participating in the fund?
Absolutely.
Right. So your argument, or what you're pointing out in terms of to the average everyday investor is, hey, instead of paying them all this money to manage your money, you're better off getting a little bit of an education and investing the money yourself.
In life, we outsource things, or we try to. We hire a nanny. We hire a cook. We hire, somebody, a mechanic, a professional that does stuff, and they do the job. Unfortunately, when it comes to something this important, like money, this is my belief, this is a skill and a task that falls on you. You can hire other people to help you. I don't need to become a mechanic to work on my car. That's something that I don't think is as valuable as learning a skill like this. So we have in life all these opportunities to outsource things. And this is where kind of that whole aspect of like, oh, we'll give it to a professional, or give it to these people. There's the market is like the sea. It's big and vast, and there's a lot of unknowns. And, before we started talking live, mm-hmm. we're talking about how you approached it and, what your kind of beliefs are. And I think your quote was, there's 100 ways to approach the market.
Yes.
Which is really true. Mm-hmm. And it's all dictated on what you first talked about, risk. Mm-hmm. How much risk do you want? The more risk you take, the more reward. The less risk you take, the less return you're going to have, but it's all dictated on risk and your appetite for risk. And because of all these unknowns in the marketplace and how things change and things are interpreted, it doesn't make any sense. It's like, it's a drunk guy at the bar, 2:00 in the morning. You're trying to have a conversation with him, and he's just not there. And that's how the market is. You just have to understand kind of that animal, what you're working with. And really what you're talking about is focused on the risk, and that's it. And let kind of the numbers play out.
Exactly. Okay. Well, today we're talking to Josh Bellinger about his views on mutual funds. And when we come back from this break, we're going to pick it up with Josh and talk more about something that's a little bit more higher risk, which is options trading. Back in a moment.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
Wealthy Investor. Wealthy Investor. WealthyInvestorRadio.com.
And we're back to Trading Stocks Made Easy. Now, we're going to go into here with our special guest, Josh Bellinger. We're going to talk a little bit more about options trading, and we're going to try to keep it as simple as possible. Options trading is more risk than stocks. However, the profit and the payoff can be enormous. So let's just talk, Josh. Why were you attracted to options? First of all, do you own any stocks?
I do not own any stocks.
Perfect. And why were you more attracted to options than actual share ownership?
Well, in the beginning, I didn't have much money. So when I first started at the firm, I had peanuts, and I needed to and wanted to be active in the market. That was what my dream was. And the only way I could really do that is if I used options, and because of the leverage and things of that sort, that's what kind of got me involved with it. Not only was that, it was what I learned as well. And I really wanted to focus in on that because I really wanted to do for my clients was to be able to help them make more money.
Yes. And we're talking specifically, I'm going to assume, about call options initially, correct?
Yeah, I think that's how most people get bit.
Okay.
They fall in. We all have this bias or this assumption,
right?
And it's usually we think something's going to go higher.
Correct.
This is how we are programmed. So we always think something's going higher, and we know when it's going to happen. So most people get involved with options. They buy options, and they're not aware, especially something like in earnings, they're not aware, which, this is not what I learned on my Series 7, implied volatility.
Mm-hmm.
And that's the component of option pricing. So that wasn't really discussed in my Series 7. It didn't say, the fluctuations of what the market is expecting is typically going to be seen in the price of the option. Not part of the Series 7 at all.
Right.
So when I bought calls, that's what happened.
Right.
There's a pricing in the market, and that's where options really help with stock and really putting context around stock, and really putting ranges and assumptions around, your kind of overall thought process.
Absolutely. So let me stop you here just for a moment, just so we can get clarification. When a call option is what's known as a derivative. So when I always like to say, when there's a small movement in the stock, there's a magnified movement in the call option. And how we know how quickly the option will actually increase in value, there's a system for determining mathematically how far the option will go up when the stock goes up. So that call option is also known as a derivative. So you trade call options probably more than anything else on fast-moving stocks, because when the stock moves up, the call option really goes up in value. Is that a fair assessment?
It's all relative, and that's kind of the confusing thing. Most people do. With the leverage you do get with options, you will make more with your money because of that embedded leverage compared to stock. It's not always going to be where you buy something for 10 cents and it goes up to $1. That's what I think of. And those are instances that do occur, and they're more relative to options that are really out of the money, and there's a surprise move that wasn't priced in, or maybe an option that's kind of at expiration on a weekly option, and kind of odd move happens as well. But, I kind of stay away from that whole aspect because that's where people get caught and they think about that. But it's all probability based. It's all relative, again, to risk, to reward. And yes, there's instances where that happens, but relatively, you lose more. If you try to go with that approach, you're going to lose more than what you make.
Yes. Okay. So let's go really slow here. So I'm going to ask you a series of questions. So if someone is just learning about options, these are some of the most common questions. Options do expire, right? So they have a limited life in that sense, theoretically. So I teach in my advanced courses LEAPS option ownership. Right? Because a LEAPS option is an option that has at least a year before it expires. In your system, in your approach to options, my question is, are you teaching 90-day, 30-day, 60-day options? What length of time do you prefer when you're purchasing an option? I'm
not really big on the purchasing. It depends on it's not to be vague, but when I talk about implied volatility, as if someone that really wants to learn this, that's the beginning point of where they should really focus in on options and really understand that, because that's the indicator that's really going to help dictate if you want to be essentially a buyer of an option or even a seller of an option. So looking at that component alone is really going to help kind of weed out some unnecessary learning curves and really help you kind of streamline your success. So ideally, if you buy an option, you want the implied volatility levels to be low.
Yes.
And vice versa. If you look to sell an option, you want to be on you want to look to sell it. And the reason why is because fear in the marketplace is typically overstated than the actual. And what I mean by that is that fear is greater than what really happens.
Yes, but most people don't realize that when they're buying an option, they do want implied volatility to be lower. But there isn't in your system, is there a time frame that you're looking at a move in the stock? Is it 30 days, 60 days, 90 days?
Yeah, so typically I'm looking at something where dictated on the implied volatility. If it leads me to, let's say, if I have a directional assumption and the volatility is low, what I will do is I will buy an option and I will sell another option. So I reduce my overall cost. I increase what I refer to as the probability of success, because now I've capped my upside. And what happens to a lot of people is they get the greed bug. They look at options and kind of what we're talking about. Oh, that option could go to, all this leverage. It could go from 10 to $1. I heard about so-and-so. I heard about so-and-so doing this and their Apple trade and whatever. And they get bit by that. Or even with stocks, a lot of times where people, they buy a stock for $100 and it goes up to 110. And then they're like, hey, I'm still in this. I want to still be part of it. It moved up $10 within a week. What else are you waiting for? Like,
right. Well, here's the thing, and just give me your feedback on this. What I have learned, which is why I always go slow, I try to make it really easy for everyone, is, I've had students who've purchased an at-the-money option that is a year out. The stock moves $7. They make a bucket of cash, and they think this is just the beginning. Right? You just got a $7 move on like an earnings or something terrific that happened in the company. You made thousands of dollars and in like 2 days, and you think that there's a greater move to the upside coming. So what you're saying is you enter your options trades, you're talking about spreads, right?
Yeah, it would be known as it's a debit spread or a call spread. So if you buy one, you're buying one close and you're selling one high. And that helps with, you're not going to get the whole benefit of implied volatility. And there's I'm keeping it very simple because there's different ways to play that assumption. But that's kind of the way that I will approach it typically is I'll do a debit spread. So like right now in the market overall, volatility is very low because of how the market has continued to move up, crash higher. So that fear in the marketplace isn't there. Everyone thinks the market's going to go to 1 million. Well, at this point in time, this is where I would be looking to be a kind of a contrarian and play where I would think volatility comes in the marketplace in the fact of prices pull back a little bit. And, because of that would also see the market kind of come back a little bit as well. So that's kind of how I would play that in that kind of situation.
Now, when you set up a spread, or another term that we use when we buy options, we're bullish on something. Are you bullish on like the S&P, right? Or are you bullish on a particular stock?
So in this instance, with the S&P, the SPY, ETF, whatever you want to refer to, the SPX, which has options as well. In this instance, with volatility low, the way that volatility would kind of increase in the overall market would be a decline. So my assumption on this one would be prices would pull back, and only kind of a contrarian view being that it's gone up, for the last month, where I would do what's known as a put spread, where it would look for prices to pull back a little bit, and also I would get the benefit of the implied volatility increasing as well. So that would be my assumption specifically on that. So with the spread, you can actually pick direction. You could be bearish on a position or you could be bullish on a position.
Right. Now, so I understand what you're saying. So it's almost with your put, you're playing the downside. With your call, you're playing the upside, right?
Yeah, that's a pure directional play. And I know you had asked this a couple minutes ago. Usually my time frames are within probably about 30 to 50 days. And the reason why I'm not an advocate for day trading and I'm not an advocate for long-term investing, I try to look at the opportunity and kind of what you're saying as what you're talking about. In the financial markets, it's a cruel environment. You could be right and still lose money, and you could be wrong and make money, and you can also be right and just not do and just break even.
Right.
And that all is dictated by risk. So if you really want to, kind of, my belief is to be successful at this. It's not really to be the day trader, because I have not met a day trader that makes money, and some of them say they do. I just never was able to be successful at it. And I don't think many people listening to this want to be chained to their computer, because that's not how I want to operate either. And I don't want to be a slave to the market, holding on every tick. I used to be that way, and it wasn't that fun. I also don't want to be a passive approach to it where opportunities are missed. Yeah, if you bought Apple years ago at $10 and it went all the way up, that's one instance out of thousands and thousands of stocks.
Correct.
It doesn't happen often. And the best way is you have to be willing to give up the upside. You have to be willing just to say, I made money and this is the best. And if it goes higher, so be it. Yeah, it's not fun, but that's just the part of life.
Well, I achieved my goals. And so one of the things that I teach in terms of options trading is like, listen, if you achieve your goal, and because we're Leaps options trader, we have plenty of time to be right about a movement in the stock. Yes, we pay more for time, right? But we have time for a stock to move $2, $3, $4, $5 within a year time frame. So what I have found, because I also teach according to what people can actually do, right? So I can know all these fancy strategies. I can teach you how to make, $30,000 a month. But if you don't have the time to actually do that, or you're not working in a disciplined approach, what good is me showing you a $30,000 a month trade? When someone comes to you to study options, what's the first thing you teach them?
It's really the core foundation. I wrote a book called Fearless Investing with Options, and it took me a while. I wrote the first draft, and it was completely different than what I have it now. And I went back to it because I was really I really was not proud of it. I mean, I wrote it, and I kind of wrote it just to write it. And I went in and looked at it, I'm like, this is not helping anybody. And I was really ashamed. So I went in, I put a lot of time into it. And I really wrote it for the Josh that had started and lost $2,000, because the lessons that I learned at that time, or if I would have known, would have helped me avoid that big mistake. I probably, and who knows, made that same mistake because it's all about risk and you're kind of hitting for the fences, which at that age, when I was 21, 22, that's fine. $2,000 to me, I mean, it's a big hit, but it's a part of learning, and I could take those kind of risks. Mm-hmm. So when I wrote this book and I went back and revamped it, I really put it as a step-by-step guide, because all the option books out there, and not to show any disrespect to anybody else, but they're just vanilla. It's kind of the same stuff that I learned. XYZ stock, call put, this kind of stuff where I walk through and I'll take your hand, Tyrone, and we're going to start with the beginning. Mm-hmm. And by the end of the book, you're going to understand the process that I use to start out with building a solid foundation. And what I believe with that being is being a seller of options, because you have the probabilities in your favor and you understand the aspects of, why, when and why to buy options, but more importantly, why options, why you want to kind of focus more on the selling part of it in the beginning, because things move a little bit slower. You have a higher chance of success.
Correct.
And you create a better probability. So like we were talking earlier about stocks, if you flip a coin, it's a 50-50 coin flip. If you buy one, that's the probabilities of success. With options, you can skew that in any way you want. So you can go in 68, 78%, where you have a probability of making money. You have a smaller amount of money to be made, but you have that's how things work in life. If you have a higher probability, you're not going to make as much. But if you want unlimited profitability, then you're going to have a lower chance of profit. And most people get caught up with that unlimited profit potential. It's like a drug. I call it the crack of Wall Street.
It is. And Josh, let me just pop in here. I'm going to lose you here in just a second, but a couple of points I want to make, and then I want your opinion on a couple of things. When I teach options trading in a bull market, I'm right 95% of the time. Right, I am profitable 95% of the time. No, listen to this, Josh. This is really interesting. So in my classes, I'm telling people I'm right 95% of the time. I'm not a Wall Street professional. But I say, don't clap for me because I'm not a genius. I just bought time to be right about a small move in a stock, right? So it's just sort of kind of like, well, of course you're going to make $10,000, $20,000, $30,000 a month when you have time to be right. And then implied volatility doesn't matter quite as much. But I have to ask you about this strategy and get your thoughts on it. There are some people, I don't trade pharmaceuticals at all, right? Because I don't have the time to be studying, phase 1 of a particular drug. But there's a strategy out there that some people say, hey, listen, get a low implied volatility option on a company that's seeking FDA approval. And if that stock moves $25 or $20, your low implied volatility option goes through the roof. Do you know what I'm talking about?
So it would be essentially kind of a strangle or straddle. So
yes.
What they're saying, and that's just a term for buying a call and buying a put. And the difference is where the strikes are. So, what they're saying is you're playing a move in a direction. So the thought process on this FDA is that, first of all, the market hasn't priced in it correctly, because that's the assumption of what you're doing there. The market hasn't priced in this expected event that's going to come out. So
from the option side you're referring to, they haven't priced in that's why the implied vol on the option is so low, right?
Well, that's what they're kind of saying. Yeah. Right. So whatever. So it could be low, it could be high, it could be, it's deemed by what they're thinking. But just going simple here, what they're saying is that maybe if the event or this news comes out and they do get approved, or maybe the news is better than expected, that, let's say it priced in a $2 move and all of a sudden it goes $4. Well, it goes higher, so the call will exceed that price and move, and that's how it makes its money. Now, if it does it on the other end, and maybe the news that everyone was thinking that this was going to get approved and they didn't, and this is the last thing for this company or whatever, it was priced in $2 to the downside and it moves $5. Well, that put will become profitable. So the call loses money, but the profits from that put exceed what you paid for the call and much more. And that's how you make money on both. That's how they would proceed that. Is it a good strategy? It's not a strategy that's going to win a lot, and it could be beneficial. So I would say if someone had a big account and they had a strong foundation and they're making consistent profits and they wanted to add what I refer to as kind of like speculative bets, which I think people should, because probabilities are fine in playing that. But it's also what's going to make separation for you is adding in those kind of assumptions and keeping you engaged as well. So if this is something that you thought and you want to do it, great. Just don't go heavy on it.
Exactly.
Do a couple contracts. So if it doesn't work out and you never did this before, at least you're not, breaking the bank. And if it does work out, you're like, oh, okay, cool. I'll maybe try this again. So I believe doing speculative things, but it shouldn't be the core. It should be a very small percentage of your overall strategy.
Absolutely. And I finance call options, long call options with covered call premium. Therefore, my risk out of pocket goes down. And I think that is the ultimate hedge, because you're really stacking the deck in your favor.
Yeah, that's one way people approach it.
Hey, listen, Josh, we're just about out of time. It's been a real pleasure. Will you come back and see us again?
Yeah, absolutely. I appreciate the time to let me to speak with you and to have your audience's ear.
Exactly, because there's a whole host of issues that we can talk about regarding options trading. And, listen, even if your approach is not 100% my approach, that's fine. Our listeners can decide, and that's really, really important. Tell everybody about optionsizzle.com. What is that?
That's the site I started in October of 2008, and that's when I left the financial industry. I was still managing money at the time, at the start of the financial crisis, not the best time. But that's when I broke away. I started Option Sizzle to really focus on helping kind of the everyday investor. And that's my real estate of where you can come and read my daily emails, which provide tips on how to become a better investor and how to trade options more successfully, and also the other content and courses that I provide on learning about options and becoming a better trader and investor.
Well, thank you so much for being here. And if you really want to learn more about Josh's techniques, you be sure to pay a visit to optionsizzle.com. That's optionsizzle.com. Hey, listen, that music is my cue. If you're into options, you know that our time has expired. This is Tyrone Jackson, the Wealthy Investor, saying thank you so much for joining me here on Trading Stocks Made Easy. And I hope you learned a little something about options trading and risk. If not, visit Josh or visit me at thewealthyinvestor.net. Either way, you'll be getting a financial education and learn an opportunity to create financial freedom. Tyrone Jackson, the Wealthy Investor, saying see you next time.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.